Welcome AirDNA data nerds. Today, live, in person, dare I say IRL, I have myself, Mariah Kamei, VP of Marketing, here with the real Jamie Lane.
Excited to be here in Denver.
VP of Research. Jamie Lane, you're with us for the entire month here in our HQ Denver. Tell me, how are you adjusting to the Denver lifestyle? Lots of biking.
Yeah, lots of biking, lots of hiking with the kids. It's great escaping the Atlanta humidity and coming to the nice dry weather of Denver. We're enjoying it very much.
Yeah, like you just have to drink 3 gallons of water a day, but it's fine.
Being in the AirDNA office, seeing all our great coworkers on a day-to-day basis, It does make it a much more pleasant environment to work at than my sort of stale room back at home.
Hey, but you do have that great map.
Yeah.
Also, yes, shout out to our employees. I think our coworkers, as I call them, and my kids call them now too. They're like, Scott's your coworker, and I'm like, well, or boss, either way. Alrighty, well, let's dig in. I know we have a lot to talk about today. You and your team just issued a huge mid-year outlook report for the rest of 2022. Before we get into it, just wanted to talk a little bit about sort of, what's happening in the industry, right? For anyone that is considering investing in short-term rentals, anyone that's just trying to optimize their profitability as an Airbnb or Vrbo host, anyone, outside of those two realms that is just interested and curious about what's happening in the travel industry. There's a lot of buzz going on right now, right, guys? There's a lot of headlines in the media, a lot of op-ed opinion pieces going out with some subjective perspective. So Jamie, when I think about like what we can add to this narrative, because it's of course already pretty loud and busy, I think a lot about what I think both of you and I pride each other and ourselves on, which is the depth and breadth of our data. It's multi-sourced data. And so, of course, like that objective perspective, I think we can really bring to the table. You've got over a decade experience as a travel economist. So hopefully, I think today, folks, what we'd love to do is just kind of like get behind some of the more objective parts of the story. We have perspective on what we think are some key performance indicators. And so hopefully that can provide everyone with a little bit of clarity for all those questions that might be keeping you up at night or might just be giving you some clickbait to dig into in the industry. So Jamie, with that in mind, what is the headline, the TLDR, I love an acronym, for our mid-year outlook report this year?
Yeah, so I'm going to start with June and then maybe dive into the outlook report because overall the years ended up better than we were expecting.
Right.
So if there was any sort of big takeaway from the outlook report is we updated our forecasts, looking at sort of the year ahead, what happened relative to what we said, right. And things were better overall. When we look at specifically for June, so the 2 data points I look at most closely is both related to demand. So how many people are actually booking short-term rentals and how many people are staying in short-term rentals and then comparing that to prior years.
Gotcha.
So when we look at nights stayed, they were up 16% year over year, up 24% compared to 2019.
Gotcha.
So that's great.
That sounds great.
Where last year was the best year ever in terms of demand, we were fully recovered. This year we're growing further off of those numbers. But then the real indicator of how things are looking forward is how many nights were actually booked in the month of June for any future month. And that gives us an indicator of the good times going to continue.
Right. Which is the burning question.
And that's the burning question. So when we look at nights booked in June compared to last year, we were up 5.8% and up over 7% compared to 2019. So a little weaker in terms of what we've seen sort of maybe in the front half of the year when people were really booking, but we're still growing off of 2021 levels. So when we look out at the rest of the summer, so what's on the books now compared to at the same time last year, we're at 11% more demand on the books. And given slightly shorter lead times compared to 2019 and slightly longer lead times compared to last year, I do expect that we're going to be in the mid-teens in terms of demand relative to last year. So all in all, and it's shaping up to be a good summer. And then even when we look out forward into the fall, booking trends are still looking very strong. We're seeing people already starting to plan sort of Thanksgiving, Christmas travel, especially for some of the high demand areas.
Well, and I think it's funny. I think you were just recently on another podcast that were talking about how like travel is, it's almost like a necessity at this point, right? Like people aren't necessarily thinking about travel as a luxury. It's more like just something that it's ingrained into our culture. So do you think some of that's driving demand? People just aren't worried about the economy and their travel plans?
I still see travel as a discretionary good. So if the economy turns, cutting back on travel is usually one of the first sort of expenses people cut. Like you're going to cut your vacation to the beach before you cut paying for your cell phone bill. Like it's just
that's true.
And part of the and what people think about, but so far, and we've talked about it a lot, the sort of key economic metrics that I'm following. It's, do people have jobs?
Right.
And do they have income from those jobs to spend on travel?
Love that simplicity. I didn't go to economy school, Jamie. I need as much help as possible when you start talking about these things.
Yeah, so we just had the sort of June jobs report come out. 372,000 new jobs being added, unemployment still at 3.6%. In terms of what we care about, that was a great report.
Right.
So, and then even like there's some more high frequency numbers like new unemployment claims. Those are still in relatively all-time lows in terms of number of people getting laid off. So there's when we look at sort of overall labor, like there's no sort of chinks in the armor there.
Love that.
On the income side, it's a slightly different story.
Gotcha.
So overall, wages are going up. More people are employed. So overall, incomes are going up, but they're not quite keeping up with the pace of inflation.
Got it. Okay.
So real incomes, so the incomes you take and have available to spend is slightly down, and people are starting to sort of eat into their savings that they've sort of accumulated over the past couple of years.
Right.
But balance sheet, sort of what you have available in the bank to spend, is still much higher than pre-pandemic. And we do expect people will start to sort of eat into those savings before they start cutting back on any sort of discretionary spending.
Got it.
And in terms of what they're spending on, there has been a pullback in sort of good spending.
Right, we talked about that before.
There may be less Amazon boxes showing up at your door.
Oh, I mean, I can only hope.
But in terms of like services, so going out and spending on travel, plane trips, hotels, short-term rentals, that is still growing at a pretty good rate.
Gotcha. So good outlook in terms of demand for travel. What else are we looking at for key performance indicators? What else should folks be?
So demand is up, but occupancy is down. And that's been a trend over the past 2 to 3 months. And occupancy was actually down pretty big in June on a year-over-year basis. We were down almost 9.5%.
Okay, all right.
So what that means is that demand's getting spread out over more units. So supply is up 25% on a year-over-year basis.
Gotcha, okay.
That's pretty big. So if you're an average host out there, it may look to you like demand's going down.
I see now. Okay.
And it's not necessarily, and there's very few markets that are actually seeing fewer travelers coming to them. It's just that demand's getting spread out over more hosts.
More options in terms of where they're staying.
So
competition's heating up.
Competition is heating up.
Okay, all right.
And it's playing out differently in different markets. So where we're seeing the biggest occupancy declines is in the areas where the most supplies come in. So mountain destinations. So if you're in areas like Gatlinburg, Vail, Breck, like some of the sort of key mountain resort areas.
Right.
That's where we've seen a whole lot more supply come in. Still growing demand. And then on the opposite side of the spectrum, in urban areas, that's where we're actually seeing pretty good occupancy gains, where demand's growing and there's not yet a whole lot of supply coming back into those areas. And if I was thinking today as a sort of short-term rental investor, that's where I'd be looking, sort of urban, suburban areas in and around some of the largest cities around the U.S. That's where we're seeing demand come back strongly and not yet any declines in sort of occupancy for those existing hosts.
I love it. You heard it here first, folks. Hot tip.
Yeah.
All right. So we've got supply, we've got demand, ADRs. So in terms of where we are with average daily rates, what's happening?
So overall rates were up 4.5% in the U.S. in June.
All right.
We're expecting them to be up sort of mid-single digits for the year. Their forecast is just about 6 or 7%. So they're growing stronger in the first few months. They're starting to come down a bit.
Okay.
But when we look at the city level and any location types, are all growing at a greater rate than 4.5%.
Okay.
So what's interesting there, it's math of rates are growing all at greater rate than 5%. But demand's growing the strongest in urban and suburban areas.
Got it, okay.
And that's generally where rates are lower than in the destination markets where people generally rent much larger homes. So it's, we call it a mix shift that's happening. But what's important for our viewers is rates are going up and still pretty substantially. So in most cities, most destinations, rates are going up anywhere from 7, 8, 10%. Relative to last year. And that's sort of what the average guest is playing to, sort of. And that's really keeping up with inflation. So last month, inflation was up 9%. We're seeing hosts now raising the rates about 9%. So if inflation is sort of representative of the average labor costs that are going into cleaning and maintaining your home, supplies that are going into sort of the act of sort of hosting, we're roughly keeping up with the increase in costs, which is good.
That is, okay. See, I didn't go to economy school. These are good things, I think, for me and hopefully other folks to know as well.
Yeah.
I love that. So could the takeaway from that be you don't necessarily need to start, discounting your daily nights if you're in an urban area?
If you're in an urban area, no. If you're in sort of mountain resort areas, and I would be paying attention to the seasonality in your market. So where last year we were in the sort of year of the never-ending summer, that's not necessarily the case this year. And you need to be paying attention to, do I need to discount in the shoulder seasons off of 2021 levels to make sure that I'm still getting the occupancy that I need to sort of make it worth it. And in many areas, it may just be some small tweaks you need to be doing to make sure that your property is sort of appealing on price-wise to potential guests. And if we do go into a recession, and we're still, most economists I follow still put it about 50-50 over the next 12 months that we could go into a recession.
Oh, there you go. I like those odds.
I don't either. And you're more than likely going to want to react quickly to those sort of changing demand dynamics. If we see unemployment start to increase, layoffs start to happening, income start to decline, it may take discounting 5-10% to induce guests to make that trip that they may not have otherwise have made.
Love that. So what are some of the other things that folks can sort of be looking at in terms of the macroeconomics?
Yeah.
Is that the right word for it?
And jobs I still think is key. Consumer spending, that's what you're going to hear, sort of headlines, talking heads on the news networks. So paying attention to that. And then I think most importantly on a host side is keeping track of the bookings in your market. So we've got it on our tools. A lot of our competitors have it on theirs. But just what do forward bookings look like? How does that compare to prior years? And get a sense of, are we are we seeing the bookings come into our market? Lead times are shorter.
Got it.
So it's going to be sort of keeping up to booking trends on a week-to-week basis. I'd be pulling up my apps every week and getting a sense of, okay, what are the bookings happening in my comp set? What are the bookings happening in my property? And do I need to adjust pricing accordingly?
Love that advice. That's great advice. And obviously our tool is superior. Let's be clear to the competitors. Depth, breadth, granularity.
Absolutely.
I love it. Well, Jamie, this is super insightful. I'm learning a lot as, again, somebody who didn't go to economy school. What else? What are some other big takeaways? What's happening? Are we seeing travel sort of move outside of the U.S.? I know we just opened that way up recently with no more COVID tests in Europe.
Yeah. I was pretty excited about the no more COVID tests for international travel.
You and me both.
But it hasn't actually been great for our industry if we're thinking about it in terms of a U.S. host.
Okay.
So let me break that.
True. Fair.
But let me break that down, because you would think it would induce more international travelers to come to the U.S. just as much as it would if you were traveling to Europe and and worried about the test coming back. So
right.
And the big piece of that is how strong the U.S. dollar is. So we just hit parity with the euro.
Right.
And that's the first time that's happened in a long time. Yeah. What that means is it's much more expensive for international travelers to come to the U.S.
Got it.
And when we look at our data, we can see that the recovery of U.S. travelers going overseas and staying in sort of short-term rentals in Europe, other parts around the world, is almost recovered. You see it in the government data too, where Americans traveling overseas is only down about 10% relative to pre-COVID levels, where international travelers coming to the U.S. is still almost off about 50%.
Okay.
So that is still really impacting the recovery, especially in urban locations that are more dependent on international travelers.
Right. So all the big cities that people want to go to.
So watching there, how expensive is it going to be for travelers coming to the U.S.? And that exchange rate is more impactful than you might think.
Yeah. Well, no, that didn't come to me logically, but now when you break it down like that, it's super logical. Love that. What are some other takeaways from the Outlook report? I know there's a lot baked in there. We'll obviously give you guys a link to it.
The other key one I was focusing on is long-term stays.
Okay.
So that's somewhere for the industry that sort of changed pre-pandemic. We do see more people staying in short-term rentals more than 28 days or more.
Right.
So it's sort of opening up new demand to hosts. And where we see that continuing, and we sort of go through it in the Outlook report, is in sort of the urban and suburban areas.
Got it, okay.
And really impactful for suburban markets, sort of the outer ring around the cities. And I still attribute a lot of that to the sort of tight housing market. With flexibility, a lot of people are traveling. A lot of people have moved outside of their home office.
They're nomadic.
They're nomadic. And then when they come back, just like I am here in Denver.
Yes, you're nomadic.
I needed a place to stay and for the entire month that I was here in Denver. And a hotel didn't really tick those boxes. So being able to stay in a home, have a kitchen, be able to cook meals at home, potentially have a pool, other type of amenities that are much more likely in a home rather than a hotel, and you can take advantage of those. And that demand we've seen really sticky in short-term rentals, even as we press into 2.5 years past the onset of the pandemic. It's become
a real lifestyle, right? I mean, Airbnb's embraced it fully for their employees. And I think the Airbnb you're staying at, pretty ideal. Agreed. You got a good hookup there.
And as more and more people start maybe they're living remotely, want to start visiting their offices, seeing their coworkers.
Yep.
I do see that being as demand that's going to stick around potentially in perpetuity.
I love it. Listing strength. How are we doing on listing strength?
We hit a new record again in the U.S. Over, I think it was 1.37 million listings. Really strong, 25% higher than last year, as I said. Most of that supply going into small town, rural destination, both coastal, mountain areas, and we just started to see some weakness in new listing growth.
Right.
So we do expect that to continue to play out over the next few months. I am expecting it to come down pretty significantly, given rising interest rates, still really elevated home prices, and essentially we're plateauing in terms of rental revenues, not really seeing a whole lot of growth there. So if the cost of a home is going up, the revenue you can make from that home is essentially flat, and we're seeing the profit potential of short-term rentals. I'm on average 30-40%, but not at the sort of 80% ratio we were at just a few months ago. So that is, I think, going to cool some of the investor interest in the short-term rental sector. I do see it's probably going to be temporary. And if we sort of, the Fed navigates the soft landing of the economy, inflation starts to go down, then Fed doesn't have to continue to raise interest rates, and we get to maybe normalized rates, and housing prices sort of settle out, revenues start to decline, and we start to see that growth again. But it is
that makes sense.
Is something, and probably good news for existing hosts.
I was about to say that. I was like, well,
maybe
it's a
not
mixed
as
bag.
much new supply coming in. We do see regulation in certain areas still tamping down supply, and we don't expect to see a lot of new supply coming into certain markets that have implemented that regulation, and so going forward, it's supply being added in the places generally that want it, and we'll see it play out.
I like it. Well, yeah, I think this is a great update for everyone. Very excited for folks to dig into that data. Again, I think like the best that we can offer everyone in the industry is more of an objective view. We really pride ourselves on the accuracy of the data that we're pulling, and then of course the great insights that Jamie's team puts together, having that perspective as someone who did go to economy school. I feel like the big headline, the big takeaway here is there is sort of this normalization of the industry, right? Like you just, you can't, it's all really relative. If you look at like that profitability we saw just with interest rates being so low, now of course normalizing a little bit, but still lots of opportunity for professionals in this business, I'd say. Yeah,
and I still see it in any market. There's going to be great opportunities. It's just maybe a little bit harder to find them.
Yeah, I think somebody wise once said, where there's a bull, there's a bear. Where there's a bear, there's a bull. Anyways, I think I know half of that. All right, AirDNA data nerds, I think that's a wrap for today. Thank you so much for joining us. We'll see you in the next episode.
See ya.
See ya. Cheers. Cheers.